Good afternoon, ladies and gentlemen. It's about that time. Thank you for being with us today. I'm Frank Pina, a principal with Mercadien PC Certified Public Accountants. And joining me today are Valentina Medora and Lee Boss to lead our discussion on COVID-19's impact on M&A and capital markets. Valentina is a co-founder and senior managing director at BDO Capital Advisors with more than 20 years of investment banking experience. Valentina advises privately held businesses with transaction structures including leverage recapitalizations, shareholder transitions, management buyouts, exclusive sales, corporate divestitures, and private placements. She closed transactions in a variety of industry segments, including manufacturing and distribution, healthcare and life sciences, business services and technology, as well as media and telecom. Lee Boss, in addition to his involvement in Mercadien's leadership and firm administration, oversees Mercadien's audit and assurance practice with a focus on business and financial consulting for privately owned companies. Whether advising on succession or strategic planning, bank financing, CFO coaching, or general financial management, Lee draws from his many years of experience serving clients in the manufacturing, engineering, professional services, construction, real estate, and nonprofit sectors. Today's webinar discusses the impact that COVID-19 is having on M&A deals and capital markets. It'll cover buy-side and sell-side trends and strategies, as well as projections and predictions affecting M&A activity over both the short and long term. Lee and Valentina will also review some succession planning tactics for the post-COVID-19 environment, really geared towards helping business owners evaluate whether an internal or external transaction is best for them and their companies under the circumstances. After the presentation, we'll leave about 15 minutes or so at the end for a Q&A session. So feel free to submit your questions through the webinar's live chat feature, and we'll try to cover as many as we can in the time frame allotted. If you're interested in obtaining CPE credits for today's webinar, just be mindful that each participant will have to log in individually using the link provided to them via email, as well as answer 2 out of the 3 polling questions that'll appear on your screen throughout the presentation. Upon completion of today's program, you can expect to receive an event evaluation in your email, which you'll need to then complete and return to us via email at solutions@mercadien.com in order to qualify for the 1 CPE credit in specialized knowledge. Within a week or so, you can expect a CPE certificate to be emailed to you then. And with that, I'll turn it over to Lee to kick us off. Thank you.
Well, thank you, Frank, and we really appreciate you spearheading today's presentation today. And for those of you who don't know, Frank has actually been heading up our COVID-19 response as a firm, helping us navigate all the various complexities related to the CARES Act, the PPP program, other financial incentive and other relief programs. So we really appreciate all your efforts, Frank, on behalf of the firm. So what I wanted to talk today about was a little bit starting with, rather than putting the cart, which I would refer to as our M&A activity and overall outlook in capital markets, I'd rather put the horse first, which is talk a bit about what exit planning is and give you a framework of a traditional approach, what we'd call a practical approach to exit planning and those stages that we would go through. And then go through a little bit about what the impacts of COVID-19 has had on that practical approach, what we're seeing with our clients and out in the marketplace. And then Valentina will take us through more the external sale, the capital markets, and the M&A activity, some trends that we're seeing there. So just quickly on exit planning, the practical approach, you'll see we outlined kind of 4 general stages that we go through with our clients and we've seen as the typical phases of this. But it is rather fluid. It doesn't really start with one and end necessarily with the last one. It's not uncommon to kind of jump around these things. But generally the first stage that we go through is part of an exit planning. When I refer to an exit planning, we're talking about either a sale, outright sale to a third party of the business. It could be an internal transfer to key leadership, to employees. That could be a sale, or that could also be an estate transfer as part of a gifting strategy to those family members or other key leaders within the business itself. So generally we start with understanding the needs and objectives of the business owner. That's the first phase, and one of the most critical phases to this, to understand what ultimately the business owner wants to accomplish. And first we look at their needs analysis. So a needs analysis is understanding what their current liquidity, current net worth is, looking at their goals and objectives in retirement, as well as other type of objectives they may have and from a personal standpoint that they want to accomplish, and understanding what they will need in retirement as far as income sources. Do they have, for example, suitable assets currently to sustain them in retirement based on their lifestyle and their goals and objectives in retirement? Is there a shortfall? So those are things that we're looking at as part of that needs analysis. And the objectives of the business owner is really critical, because as we'll see, there's a lot of different avenues that can be pursued when it comes to exit planning. We could do an internal sale, an internal transfer, or a third-party sale. And that third-party sale could be an outright sale, it could be a partial sale, and so forth. So understanding the objectives of the business owner is really critical. And we like to look at things such as determining the vision of the company without the business owner. So looking at the company and understanding where does the business owner want to take the company, or where does the business owner see the puck going for the business down the road? And also determine the vision of the business owner without the company. So for example, does the business owner still want to be involved with the company in some capacity, maybe as an advisor to the future owners, or do they want to completely remove themselves from the business and enjoy a healthy and prosperous retirement without any of the potential headaches that come along with owning and managing a business? So the objectives, we go through a lot of things. One of the objectives of the business owner might be, for example, to get top dollar as part of a sale. And typically we'll see that in a third-party sale is where you're going to receive top dollar as opposed to an internal succession transfer. Is it important that they receive cash consideration or larger cash consideration up front as part of an exit plan versus what we might call as taking paper or getting paid over some period of time for the business? Is it important, for example, that the business owner leave a legacy? Many of the businesses are second, third generation businesses. Is it important that they continue that family business, and that's something that they'd like to do, and leave a legacy in the community as far as that business name? Again, as we talked about, do they want to stay involved in the business, or do they want to remove completely? And if there are family members involved in the business in some capacity, or maybe not, but they have an interest, is that something that the business owner would like to transfer or sell that business to family members? So first kind of step is just understanding that needs analysis, going through the objectives. Most critically, however, as we go through this process, is really understand where the business is headed. And this is what we call understanding the strategic position and outlook of the company. And traditional, to keep it simple, would be a SWOT analysis of strengths, weaknesses, opportunities, and threats. Understanding where the business is most competitive, where does it derive its competitive advantage in the marketplace, and where are some of the weaknesses? So for example, does it have an existing strong leadership bench? Or is that leadership bench nearing retirement as well? Or are they younger leaders? Do those leaders have the technical expertise, the business development skills, and managerial skills, for example, to lead the business into its next phase? Market analysis is a really important part of this as well, to understand how relevant the business is in the marketplace and where's the outlook of that industry and the market overall going. Does the company fit a spot there? Is it innovative? Will it have a future in the marketplace, or will it have to adapt significantly? These are all important questions to understand where the business is going as far as assessing what's the best option for the business, either internal sale or an external third-party sale. And of course, financial projections play a huge part of this, understanding both the historical financial performance of the business, how much earnings before interest, taxes, depreciation, and amortization, and income to the business owner is generated, but also future projections of what the likely income will continue in the near future. Once we have all of that in mind, we know the needs, objectives, and we understand where the strategic posture of the business is and the financial outlook, we can then evaluate the various exit planning options. And for simplicity purposes, we listed really three here that are most common. First would be an internal succession, and a huge element of this is first understanding, do you have any interested and capable management leaders within the business? And when I refer to as interested, do they have a stomach for the business? Is it something that they want to be an owner and have to deal with the various rewards as well as some of those challenges that come along with being a business owner? And are they capable? Are they capable not only in today's environment, but based on the environment that you foresee in the future, based on that strategic assessment we talked about earlier? And then deal economics. So of those interested insiders, could that be family members or key management, or perhaps you're even looking at a broader based sale to employees through an employee stock ownership plan? We want to understand the financial balance sheet of those potential purchasers. Do they, for example, have cash or other consideration that could be provided as part of a transaction? Or will that transaction be primarily financed through the ongoing economics of that business, meaning that the owner will actually take paper or take a note and be paid back over some period of time as the business generates that cash flow? External sale, we'll speak more about that. Valentina will get into the environment that we're looking at in the capital markets for M&A, but a big component is who are the suitable counterparties? What's the universe look like for that? You have both the strategic buyers, those that kind of align with the industry that you're in or that would be complementary or creative in some way to the industry, as well as financial buyers. And we think of things like private equity groups and so forth that would like to kind of unpackage the company and sell it down the road at some point. Deal economics also factor in significantly for a third-party sale, external sale. For example, will there be things such as earnouts, or will there be more consideration up front as part of the transaction? And many business owners kind of take a wait and see approach. So they do this assessment, and to kind of step back, ideally, this assessment would be done at least 5 years prior to any likely transfer or exit. But even better would be 10 years out to do this assessment to really understand where the business is, what the options are, and how you build to the ultimate exit plan that you want. So we kind of, sometimes it's a wait and see approach. We know what we know today. We're working on that plan if that's an internal succession plan. But things change, just as we've all been experiencing over the past few months here with COVID-19. Things can change relatively significantly on some of the assumptions and areas that you initially thought about when it came to a succession plan. For example, maybe you had key employees, but due to whatever issues now, some of those left. So your decision factors may change. You could actually flip from an internal succession path to potentially an external sale. And obviously the market conditions play a huge role of that too. So we then decide on the path and we work the plan. If the plan says we're going to do an internal succession and we need to develop a deep bench of our leadership, we need to get them specific training, we need to mentor them, we need to get them involved in the business more broadly, then that's what we do. If the plan is that we're going to do an external sale, we'll actually start going through the process of engaging an investment banking firm or capital advisors such as BDO, and work on the marketing materials and so forth, get evaluation, get an understanding of what the potential counterparties are. So now the thought is, how do we fit this into this traditional planning approach into a COVID-19 world? And these are some of the things that we're starting to see based on COVID-19 and how this will impact exit planning going forward for clients and for business owners. The big thing first that we need to understand is the needs and objectives of the business owner, as we mentioned. And there's a lot of things that have recently occurred which are significantly impacting this decision tree. So for example, market decline. A lot of individuals have suffered relatively significant impacts on their investment portfolios. The businesses obviously have been generating, many of them, I would say, vast majority, financial losses in this period of time. And as a result, there's depressed valuations out there that are impacting the net worth of the business owner. So this may actually require, in order to kind of recover from these losses, recover from the market decline, but yet still meet the needs in retirement, it may extend the retirement date. Also could be a sacrifice in the deal valuation, and may need to continue to reevaluate the internal versus external succession path. So we may have been kind of gung-ho on an external. I have some clients that were actually in the marketplace for an external sale that, due to COVID-19, that's been put on the shelf because of these issues, because primarily decline in valuations, as well as lost interest out in the marketplace for a deal. So these are things that have been evolving. There could also be some differing objectives now of the business owner. I've seen this where, the business owner initially wanted to leave a legacy, have family members involved in the business, and due to some pretty significant impacts in that business due to COVID-19, they're now questioning that. Do they want to leave this business to, for example, their son and their daughter? Are the key leaders still interested in the business? Are they still capable based on what you've seen of how they've been able to manage through this? So a lot of changes in both those needs as well as objectives due to COVID-19 that we've seen. Understand the strategic position and outlook of the company. I think this is a huge one in the COVID-19 and post-COVID-19 reality is, what does the business look like in this new environment? Are we still positioned to be successful? Do we have to adapt? Do we have to change the type of products that we're selling or services that we're offering? Do we have a different model of performing those services to our client base? What type of investments are going to have to be needed to adapt to that and answer that? And what type of financial commitment will come along with that? So these are all things that are impacting strategic position and outlook. The next thing is evaluating those exit options. And as we talked about, business valuations are likely to be lower in this environment. Most businesses have seen a significant impact, so those businesses are seeing a decline in their business valuation. And a lot of uncertainty. Business valuations do not like uncertainty. The more uncertainty, the more haircut on valuation you receive. So we're seeing a decline there right now. As we talked about, internal succession, assessing the buyer's interest. Are there key leaders, key members that you might sell to otherwise as part of internal succession or transfer that they may not have an interest in the business anymore? And the capability, there are new things they may have to adapt and learn, things in this post-COVID environment, such as how to manage a remote workforce, as an example, or how to be responsive to your client, your customer needs, how to source additional vendors, to how to manage your supply chain. These are all challenges that we're all facing as business owners, and things that a likely internal succession candidate is also facing, and they have to be capable. So understanding their capabilities and their, what I would call their stomach for this, is something that's really important. As we talked about investments required to succeed, what type of investments may you need to put in for increased technology so that you can manage a remote workforce, as an example. External succession, we're going to talk, Valentina will walk us through a bit about some of the COVID-19 and post-COVID-19 realities related to our external succession or third-party sale. And what I've been seeing recently is this decide on a path forward and work the plan, is that business owners have been really just stretched, doing anything they can at this point, working in the business, in the business. So what I refer to that is actually rolling up their sleeves, making decisions, getting things done, working with their customers. Many times in the past where they were able to manage those processes, they may be now the face of the business to their customers. So working in the business versus working on the business. Exit planning and this third-party sale is ultimately an on the business type issue. And the time has been really stretched in that area, I've seen. most business owners have been really working in the business as a result of COVID-19, and I would expect that will continue for the foreseeable future until we get more certainty around this issue, at which time hopefully we can all start focusing more on the business. So I wanted to actually turn it over now to Valentina to walk us through the capital markets and M&A outlook.
Thanks, Lee. First of all, I want to thank you very much for having me here today. This is obviously a topic of interest across the board for business owners and advisors. And everything that Lee has shared with you today about succession planning really points towards preparation. And we could not be emphasizing that anymore to our clients and our prospects when we're speaking with them. It's really essential at this point to prepare, and whether that's a year down the road, 5 years down the road, or 10 years down the road, is doing that diagnostic analysis of the business and then, preparing accordingly. So I want to share with you our perspective on the capital markets, on sell-side M&A and buy-side M&A. And I will tell you that from doing presentations over the last 2 months, every week is different. So this is kind of a snapshot view today, and I'm hopeful that everything we share really just continues into a progressive and improving state. So let's start off with where we were kind of going back to March 13th. The COVID-19 pandemic, it effectively catapulted us into the deepest recession that we've been in since the Great Depression. And that actually provoked an unprecedented fiscal and monetary response by the Fed. And thank goodness for that, because what it did was it enabled the survival of the equities market. If you look at March, the reversal in capital flows in the 4 weeks ended in March matched the decline during the 08-09 great financial crisis, and that took a year. We got there in 30 days. So effectively, the Fed stimulus packages have enabled us to survive that and continue with an equities market that has effectively been performing counter to the rest of the economy. If we look at the debt side of things, we have senior debt market frozen starting with March 16th, and that effectively froze all M&A deals. Publicly held companies were taking away their guidance for 2020, and you can see with some of the hardest hit industries, consumer discretionary, restaurants, hoteling, everything was off about 40%. If we look at new issuances and IPOs, what was anticipated to be one of the strongest IPO years went bust. The first quarter through the end of March 31st saw 235 deals go out to market with nearly $29 billion of value raised. But after the 16th of March, everything came to a grinding halt. And IPOs are now on pause. They're going to go through a cooling off period. And the issue with new issuances or IPOs is it only makes sense in an incredibly solid environment. And that's what we're not operating in. We're operating in a period of uncertainty, and that's certainly not conducive to an IPO structure. So with debt, with new issuances, if there are issuances of debt, what we're seeing is that the basis point interest rates on these issuances are far higher, 200 to 300 basis points higher than pre-COVID. And that's making capital extremely expensive for M&A as well as organic growth for privately held and publicly held companies. Let's go to the next slide then. If we now fast forward then for, I guess it'll be 2 months now, what we're starting to see is signs of encouragement and improvement, albeit the recovery is not imminent. And the one thing that we're certain of is that many things have changed. And that change is going to continue for the foreseeable future. So one of those changes, and much to my dismay, is that the bull market is dead. So we went on a 10-year tear, and I remember telling people, look, this is a window of opportunity that you need to take advantage of. And all of a sudden, that window of opportunity shut tight, really in the middle of March. The market's resilience and exuberance, though, and I'm referring to the equities market, really has been more policy-driven. That's why we're seeing this incongruence between the economic numbers and what's happening in stocks and the equities market. The government essentially injected repeated shots of adrenaline to the tune of about $3 trillion in economic relief. If you look at the CARES Act, $2.2 trillion, to more recently the $484 billion economic relief package, and I know there are more bills on slate right now to be passed. All of that has given the market and consumer sentiment, reason for encouragement that this will in fact pass. As we look, however, at how this market is evolving, there's been a lot of debate about what shape of recovery that we'll be in. And at least from our perspective, it's unlikely that this recovery will be V-shaped. As COVID-19 is leaving lasting imprints of change throughout the marketplace, and that V-shaped recovery seems almost impossible at this point. But whether we see a W shape, if there is in fact a second wave, or a U-shaped recovery, or maybe even a swoosh, it's really hard to predict. The next 30 days with foreign and domestic markets reopening, I think that's going to be the most telling indicator of how quickly we can recover from the marketplace, and what the nature of that recovery is going to be. As you can see on this slide, the thing that we're dealing with most is the shift in leverage. And what caused the crash in 2008, 2009 was the lack of leverage. What's interesting about this particular pandemic is that we're not operating under a function of a financial crisis. This is a health crisis. So that gives us a little bit of encouragement that the recovery will be at least more rapid than we've seen historically. And that's a nice segue, if we go to the next slide, to really look at what's happened on the sell side and what we can learn from past disruptions and how they can inform our view of what may happen coming out of COVID-19. So I think we can all agree there's no modern precedent for COVID-19, nothing that we can point to and say that happened, this is how we'll react from it. But if historical disruptions have taught us anything, it's that every past disruption is absolutely unique. However, we can use past disruptions, including the tech bubble, which occurred in 2000, 2001, and the great financial crisis, which I'll refer to as the GFC, in 2008, 2009, to at least provide us with some insights into the potential impact on M&A going forward. And it's interesting because M&A, and what we'll demonstrate here with these slides, has a direct correlation with GDP and with the overall economy, but the timing is actually different than the recovery of the overall economy. So while the past disruptions, including the tech bubble and the GFC, didn't occur in a fear-based environment as this pandemic has, their impacts have still been felt largely the same. So this chart, what it's showing you is it's correlating the year-over-year percentage changes in GDP growth with the year-over-year percentage changes in M&A activity. And that's really across various size segments. So you can see in the lower middle market, we have deals valued between 0 and 499 million. And then as we move to the mid-market, highlighted with the blue line, and then the gray line indicating, the middle market being in the gray line, and then the blue line denoting deals over $1 billion. Anything over $500 million, we can kind of look at what happened with GDP growth vis-a-vis what was happening in the M&A market. And what we can draw from these past periods is that changes in the middle market and the bulge bracket have had a much more pronounced effect than the impact on lower middle market M&A. So on this chart, you can see that the lower middle market is denoted by the dotted red line. And you can see that it's clearly less erratic than what we were seeing in the middle market or the bulge bracket. So we didn't experience the erratic increase or decrease, but rather we just saw a 20, 30% decline here, and then we're coming out of it at an equally normalized rate. So from that perspective, most of my deals are in the lower market, the lower middle market, and then up to the mid market. That's where we're still saying to sellers, there's still a market that's thriving here because you're not seeing those pronounced or erratic changes. So really, in looking at this chart going from 2007 through to 2010 and looking at the impact of the Great Financial Crisis. Although there's a direct correlation between the changes in GDP volume and M&A activity, we can say with certainty that there's a lower volatility in the small and mid-sized end of the M&A market during economic disruptions. And also, coming out of this previous recession, we saw two types of transactions. So we saw, one, great companies being pursued by a deep field of buyers. And then two, we saw more unique situations with smaller buyer universes. We would expect to see the same thing post-COVID-19. So if we go to the next slide, then we can kind of fast forward the timeline. And we can see what happens looking at the current time period between 2017 and 2020. So the other thing that past disruptions have taught us is that M&A typically acts as a precursor to a recession, as well as a precursor to a market rebound. So really what we need to do is assess where were we in the M&A cycle going into COVID-19, and then how long will it take us to come out. So as I mentioned, economists can't really define the shape of this current recession, so whether they were V-shaped, U-shaped, or W-shaped. But what we do know is that based on the past disruptions, M&A volumes are likely to correlate with GDP impacts in the near term. And now we have to ask ourselves, so what does that correlation mean to the M&A cycle? So the exhibit on this slide charts the same data that we looked at before, looking at year-over-year percentage changes between M&A activity and GDP volume. And this, again, is for the years between 2017 and 2020. From this chart, you can see that the deal volume actually started to decline in 2017. That was pre-COVID-19. During this time, we didn't have any issue with the economy. It was actually on very solid footing. We had historically low unemployment, leverage abound, and progression on global trade issues. Therefore, if we look back, and actually, if we can kind of go back to the previous slide just real quick here. If we look back to that previous slide, we can reasonably assume a similar response coming out of this recession that we saw coming out of the GFC. And you can see here we saw quite a significant uptick starting with the earlier parts of 2010. So while we can't determine the economic recovery, we as bankers really feel that we may be looking at a V-shaped recovery now coming out of 2020. And as M&A has historically followed typical cycles of 2 to 3 years down and 4 to 5 years up, if our period of decline started in 2017, presumably we should start to see an upward cycle movement starting in the fall of 2020 and going into 2021. Okay, so what does this then, how does the understanding of these M&A cycles during this particular pandemic, what does it mean for sellers and where we are today? And look, I can tell you honestly, from a process standpoint, the traditional M&A market has gone through a complete upheaval. And everything has changed. And speaking with other deal professionals, looking at our own backlog in our deals, buyers, lenders, investors, the approach to evaluating a business, due diligence, time to close, everything has changed and there's a new normal. What we are seeing, however, is that both buyers and sellers are willing to conform to that change. So if we look at the late stage deals here, actually going over to the right side, I'll kind of work my way backwards. These are deals that were predicated on financing, and they were pulled immediately in the middle of March. MAC clauses were exercised. Buyers, both strategic and private equity firms, still trying to get their hands around future performance. And in the next 30 to 60 days, if the company services a mission-critical need, meaning a coronavirus vaccine or underground infrastructure repair that's essential, or the significant synergies outweigh the temporary loss of traditional valuation metrics, or finally, if you can do this deal with modest or no debt financing, then those deals in the late-stage category are going to get done. And they're probably going to get done, I would say within the next 30 to 60 days. I have 3 deals on the cusp of closing between the end of March and April, and I categorize those as those late-stage deals. And I'm fully confident that, over the next 30 to 60 days, we're going to see those deal closures because now we're just seeing greater momentum in the lending market. With the deals that were launched or engaged deals, these are really deals where we're at a stage where we have to monitor the impact of COVID-19 on the supply chain. We have to evaluate changes to the business. Apologize, I may have been unmuted there. And what was really the impact to the financial performance on the company, both short and long term? So it's doing this industry assessment. If you look at industries such as construction, consumer discretionary, hospitality, and restaurants, these are businesses that need to take a pause unless it's a distressed sale. And if you look at technology companies, including video conferencing, supply chain tech, I have a electronic data interchange software company right now. We're taking that company to market because that particular industry is stable, the company is operating, and COVID-19 has had very little impact on it. So it is going to be sector specific. And I think when you look at the engaged but not launched category and the launch category, that's really what needs to happen. If you can get comfort on the interim projected performance, that will move you to the next stage of actually launching into the new normal. And this new normal still remains untested. So we're going to be in virtual management presentations, due diligence, and limited face-to-face meetings are going to prevail. And I believe we're going to see an elongated process. And that's going to create additional uncertainty. And I think this is what Lee had alluded to earlier. Uncertainty really means a discount in value. So it's more critical than ever that you prepare and have your advisors work together with you to make sure that the narrative that you're putting out into the market can sustain the due diligence that buyers are going to put you through. And it's a forensic due diligence. The level of scrutiny today is much more heightened than before. Let's go on to the next slide then and just look at what this is doing in terms of structure and price, because these are some of the first questions that people have asked me. So if we look at where we were pre-COVID-19, we've kind of had a seismic shift in the deal environment. We've gone from a seller's market to a buyer's market, effectively in 0 to 60 seconds. So 90 days ago, we had a deal frenzy. We had competition among buyers, record valuation in 30 to 60 day due diligence periods. If we fast forward to March, the industry effectively has come to a grinding halt. The banks went on hiatus, PE deals were paralyzed, and strategics, as I mentioned, started exercising MAC clauses and pulled out of deals. So where are we now? I think the shift is really impactful in two ways. One is on valuation, and the second is on deal structure. So from a valuation perspective, the fundamentals are broken. When you think about valuation of a business, it's really a function of its EBITDA. It's its growth prospects, an appropriate risk-adjusted rate of return. Right now, what we can't do is we can't determine valid projections. And without that, it's really hard to calibrate the risk. So if you can't calibrate the risk, you really can't value the company. So companies right now, or buyers, are relying less on one stable assumptions and relying more on robust and nuanced examinations of all relevant variables, meaning key performance indicators, operating metrics, and trying to extrapolate the growth of those businesses. What it's doing is it's resulting in a dislocation between buyers and sellers. And unfortunately, when you can't calibrate risk, you tend to undervalue the company in order to protect yourself and downside. And so that's where we're seeing that we've fallen out of equilibrium in terms of seller expectations and buyer expectations. And until we can get back to that equilibrium, we're going to see this dislocation affect the number of M&A deals that are transacted in the marketplace. And I've seen that on some of my deals. We really have probably a 10 to 30% valuation gap because buyers are looking at current state of EBITDA versus what the company really should be at under sustainable and normal operating conditions. But again, it's difficult to define what normal is. The second impact is structurally. So right now, downside protection is paramount from a buyer's perspective. Cash at close is minimal, and it's really on account of less leverage being available to fund the deal. So what we've seen is that buyers are still honoring pre-crisis level multiples, and they're looking at the comparable companies in the marketplace. And as I mentioned, the equities market is still performing, but they're transferring the risk into contingent payments, or they're using esoteric securities to try to protect their downside. So on the contingent payments, we're seeing earnouts come back again. And honestly, it's been 10 years since I've had to entertain an earnout on one of my deals, because we've always been in a position of leverage, and so we've negotiated those fundamentals out. But now earnouts are becoming the norm. And that's really because you just can't determine what the company's sustainable run rate is. The problem with an earnout, and I would highly recommend that nobody engage in an earnout structure, is that even when I am negotiating that from a seller's perspective and structuring it as favorably as I can, there's no way to determine what the projections are for the business. And so my feeling is that regardless of how you structure that earnout, you probably have a 20 to 25% of actually achieving it. And you could be doing carve-outs, you could be doing clawback features. It doesn't matter. It's really hard to get to a place where both the buyer and seller are going to agree on those numbers. But what we also are seeing, we're seeing seller notes. So have the seller fund part of that transaction. And, you know, a seller note where the buyer is giving you a 6 to 8% interest rate on that paper, that's very good paper because you're not getting that in the stock market. So as long as you can get comfort with the buyer's ability to continue to run that business and have it pay back that seller note, I think that's actually very good paper to entertain. Finally, what we're seeing is security structures. And unfortunately, we're seeing the introduction of participating preferred security or convertible preferred securities. And especially with participating preferred securities, please understand that that is simply a technique that buyers are using to protect their downside risk, but they also get an enhanced appreciation in the and participation in the company's projections going forward. Meanwhile, the seller gets very limited upside participation with no downside protection. So if you see those words, participating preferred, take a step back, engage your attorneys or a banker and make sure you understand what that means, because it's highly impactful from a negative standpoint to proceeds down the road. Let's move on then to what deals are going to get done now, because what I've effectively said is we have an impact on valuation, we have an impact on structure, so why would you go out to market and transact deals? Well, at least for the next 30 days, what we are seeing is that deals that are getting transacted are those with liquidity needs. So spin-offs, distressed sales, minority investments, any sort of structured transaction. Or those deals that have a highly strategic deal rationale. So effectively, if the revenue and cost synergies can outweigh any uncertainty around valuation, then those complementary tuck-ins are getting done. And or again, the businesses serve a mission critical need. We're also seeing consolidation of weaker players and long-term secular trends that are prevailing. So I'm actually going to be meeting with a business that is a distributor for janitorial supplies and industrial packaging and disposables. They're having a record month. That's the type of business where you don't wait for the market to correct, because there's still capital out there in the marketplace. So my advice to this company is really go out to market. There will be plenty of attention from investors, and structuring that deal will be more favorable for that particular business than it will be a business that may be 30 to 40% off of its projections and its EBITDA. So again, this is very specific to industry and sectors, and you really need to dissect the company to determine what is the right timing of going to market. If we then look at, I kind of talk about what are the winners and losers in the marketplace. If we shift to the next slide, we can see some of this. And the pandemic's effect on industry landscapes is shifting, and it's shifting daily. And it is creating opportunities, as I mentioned, for some distributors or for software companies, and it's redefining the business models for others. So the first thing that businesses need to do is they need to sit back and they need to understand where they kind of fit on this slide. If we look at the more attractive sectors, online education, social distancing, is redefining the value proposition of remote educational technology, but for the benefit. So these businesses have demonstrated enormous business agility in pivoting from in-person sessions to the digital realm. That makes them highly attractive from an investment standpoint. If we look at e-commerce, I feel like we're in round two. First round was back in the tech boom in 2001, 2002. Now e-commerce is driving us out of this pandemic as well. So a digital presence and platform are absolutely critical for survival in today's age, and probably never more so than throughout this pandemic. So case in point, there's a company called Shopify that is a Canadian-based business. They offer solutions for SME businesses to establish an e-commerce infrastructure. They just catapulted to the number one publicly traded business on the Toronto Stock Exchange over the past 2 weeks, and it's because their solutions have never been more in demand. If you look at these traditional brick and mortar companies that didn't think they needed an online presence, what they've learned in a very short few weeks as it's becoming essential to survival. Health tech, obviously garnering a lot of attention these days. Healthcare is changing, and perhaps permanently. So the standards for cleanliness and safety is really raising questions about whether or not we're going to continue to have waiting rooms and how you're actually serviced by your physicians. Businesses that can deliver more healthcare via telehealth, they're going to be the clear winners, in this race. And then, as I mentioned, packaging, industrial technology, they're both benefiting from direct-to-consumer tailwinds. So we've got industrial tech that was already getting a lot of attention from the industrial Internet of Things. That's going to continue to grow based on need for virtual and technological connectivity. And unfortunately, if we move over in this slide to the upper right-hand corner, travel and hospitality, restaurants, alternative lending, fitness gyms, those are really the losers in the race. It's going to take a long time for these businesses to recover. We do believe they will recover, but these are really the businesses right now that are driving those liquidity need deals, and probably not the ones that we would be working with today to position to go to market in the near term. If we go to the next slide then, understanding where businesses fit across the landscape of winners and losers. The other question that I've been receiving a lot from sellers is really, how do they prepare for a sale post-COVID-19? And, I think Lee touched on a bit of this, and I'll just kind of go through some of these points because I think they're incredibly important. As I indicated, preparation is key. So we believe the market for M&A is going to turn fairly quickly. And importantly, remember that, as I mentioned, it's not a financial crisis we were in, but a health pandemic. So based on those past disruptions and looking at how we moved out of the GFC and the tech crisis, M&A is going to be a precursor to lead the market out of a recession. And I think there are really 4 key determinants for when and how a business reenters the market. The first one is really reviewing your strategic plan. So as a buyer, they need to establish an acquisition strategy and parameters for a target search. As a seller, you really need to determine your sale timeframe and begin preparing the company for sale today. And a lot of that is going to be around the narrative. Now, I don't think ever more so in the history of working in M&A have I felt that a narrative is more important. You need to create a story of business performance outside of the pandemic. So a few things that need to be considered. You need to assess the long-term growth prospects of the business within the industry as it existed pre-coronavirus and then independent of coronavirus. And then assess the impact of the virus on your prospects, on your supply chain, on all of your suppliers and customers. And then you need to look at the likelihood, the immediate visibility on normalized business performance based on the interplay of both of those 2 previous points. So there's a lot of analysis that has to be taken into account in this narrative. And as it relates to some of these points, and I think Lee touched on this, sellers probably aren't quite there yet. They're focused right now on the performance of their company, on their employees, on bank relationships. I think that's critically important, and I would not be suggesting that a seller move away from that and be thinking of building a narrative. But within the next 90 days, in order to survive and come out of this pandemic successfully, the business owner really needs to shift to the process of discernment and understand how their industry is perceived by buyers and investors. If you're in telemedicine, branded, safe, clean food, or online education supply tech, a strong narrative can be built today. Businesses in those discretionary markets that we talked about, it's going to be a longer road. But you still need to start today and track some of the performance indicators and figure out how you're going to move forward. And that really leads me to my third point, tracking performance metrics and KPIs. So now more than ever, in order to migrate the buyer away from a cash focus and just looking at EBITDA, we need to look at the metrics of the business that can be extrapolated over the short term to enable us to figure out what will happen with the business in the longer term. And otherwise, you're going to be priced off your current cash flow. And so that makes it very difficult to reach the valuation targets that as a seller you may potentially have. And finally, from a buyer's perspective, they're going to be taking a more forensic view in due diligence. So they're going to do a complete analysis of the company's supply chain, changes to customer demographics, and identify where there are weaknesses in terms of logistics providers, production shutdowns, receivables, and payables. And there's going to be a greater focus on working capital. The due diligence hot topics are going to include anything that relates to the PPP loans or small business loans that were assumed, and then how that was repaid and what the effect was on any furloughs of employees. So the scrutiny around due diligence is more heightened than ever, and you really need to go through that preparation process. So if we could go to the next slide, I just want to kind of close out the sell side then and leave you with these final points. You know, I think what we have determined is that the GDP changes are going to dictate M&A volume, but only in the short term, and it's going to have far less impact on lower middle market M&A. Liquidity needs most definitely going to be driving the deal flow over the next 60 to 100 days. And with improving market conditions, we do hope to see a realignment between buyer and seller expectations, both structurally and then as well through valuation. The recovery in M&A is going to be sector specific. So if you're operating one of the core industries we discussed and considering a sale, this is actually a great time to be in market, and I would not hold off on going out to market. And then finally, preparation is key. So the right narrative is not only going to garner more value, but it's going to increase the probability of close with the chosen party. As you recall me saying, uncertainty begets a discount, well, certainty begets value. So that's what we have to remember as we go through this process. Let's just shift then to the buy side. And, you know, I think what we're seeing is that now is a better time than probably the last or previous 10 years for a company that is in a position to go out and acquire another business to take advantage of that window. So if you look at the chart that I have up here, it's showing you valuations of middle market companies between 2006 and 2019. You can see just before the crash in 2009, we were at a 12 times multiple. So if you look then, we dropped about 3 levels going into 2009, and we went down, or actually 4 levels, down to an 8 times multiple. And we kind of hovered around that level for the next 2 or 3 years. A 3 times or 4 times multiple change on a deal is highly significant. If you look at a $3 million EBITDA company that might be out there for purchase, you're talking about effectively, a $12 to $16 million valuation change. And if those businesses are in dire straits, they're going to be willing to do a deal. So we really need to look at the M&A cycles, both from a seller perspective, but also buyer perspective, and say, is this a good time to go out to market? Well, we do see those valuations coming off of their highs over the next 12 to 24 months. And so I do believe that from the buy side, it's an optimal time to go to market. If you have capital on your balance sheet, if you have a strong financial performance, go out, because organic growth is going to be limited. Go out and do those deals now. There is strong evidence and data points that suggest that M&A transactions executed during these early phases of recovery have generated some of the best market returns that we've seen historically. Let's go on to the next slide then and just see kind of what's happened globally with M&A, at least year to date. And you can see almost in every single market, we're off significantly. anywhere from about 23% up to 82%. So activity is highly cyclical, and the biggest reason is the bid-ask spreads now are really to the point where buyers and sellers can't come back to that equilibrium as it relates to valuation, something I was alluding to earlier. So buyers are struggling to value assets while the economy is in a free fall, and sellers are struggling to adjust the lower valuations. So again, where buyers can identify those targets that make strategic sense, irrespective of what's happening with COVID-19, they can take advantage of some of those sellers that either are well represented or are comfortable with contingent payments. So you're extending the capital requirements of that purchase by using, an earn-out or using a seller note, or just adjusting the valuation based on the company's current EBITDA performance. If we go to the next slide, then we can kind of see, how prior recessions have enabled buyers to take advantage of this, and what we've kind of seen as key themes. So I mentioned that businesses with liquidity are really the ones that are going to get transacted today. So spin-offs, distressed sales, and minority investments. And then buyers are going to be much more focused on quality. We just had a conversation with one of my clients today. They had almost transacted with a buyer back in December and concluded that, and really the negotiations went awry. And so they concluded that they'd rather go into market through a process. Well, what we've emphasized to them is the one difference they're going to see in the marketplace is the scrutiny that the buyers will put on due diligence. So we had a sell side Q of E done before going into market. I think that's absolutely critical today. If you are a manufacturing company, get your phase 1, phase 2 done, have a sell side Q of E done, make sure that you have your house in order before going to market, because giving the impression of a clean financial balance sheet and income statement is really going to enable the seller to hold to that valuation that was negotiated in as part of the LOI as you go through the SBA process. The other thing we're going to see is that the depressed public equity valuations, to the extent that we do see some of those, are going to be in the form of PIPE transactions and take privates. And then again, we're still going to see those strategic deals that make sense. And I've mentioned, taking this software company into market. We have, multiple buyers that have reached out to us because they're very interested in this company. And the COVID pandemic is not impacting their interest level, nor the strategic need to acquire this type of business. So again, you've got to look at the secular trends and what industries are doing well and which ones aren't. And if we go to the next slide, we can kind of conclude then as we look at some of these buyers and kind of what is healthy M&A. Today's buyer universe is going to be looking at growth. They're going to proceed cautiously and with deeper diligence. And they're going to try to, attempt to reprice and restructure terms, favorably for their own benefit. And then you've got the opportunists, and they're more value-oriented. So they're going to be looking at turnaround and distress special situations. They're going to look at those companies that can't fund working capital and need liquidity needs. And then you're also going to be looking at, bridge financing and trying to get through the next 3 or 4 months. And that's really where the capital is in the market. That's what they're chasing these days. So, I guess I would sum up, both the sell side and the buy side and even the overall capital markets by saying that we do anticipate a return of a normalized economy, albeit I think that's going to take more of an 18 to 24, maybe even 36 months. But the M&A market will be a precursor to that. So we're going to start to see that shift in the next 6 to 12 months, and being prepared to go to market, especially where your time horizon aligns with the objectives of selling the business, and if the performance of the company is in line as well. Now is the time to, work with people like Lee on developing that succession plan and getting your house in order so you're ready to take advantage of the market when it actually turns. I used to say to people coming out of the last recession, we're hitting the apex, but they just felt that, that time horizon was much more elongated. And I would say that the apex was really 2014, 2015. when I went out to market, I could ask for any valuation with any sort of terms and structure, and I got everything I asked for. And all we saw subsequent to that was it became harder to get the price and harder to get the structure. So again, preparing to go to market as the market is coming back is going to enable, that increase in valuation, the willingness of those buyers to meet those structural demands, and ultimately find the best fit for the seller with a potential buyer. Frank, I might turn it back over to you then for questions and closing.
Sure. So thank you, Valentina and Lee, for that informative presentation. At this time, we do have maybe 5 or 6 questions from the audience, or some of which were submitted in advance that I'd like to address to you guys. I'll kick the first one over to Lee, and feel free to, chime in as you have something in addition to add. But the first question really relates to, in a world where physical contact is limited, what strategies, if you were advising a buyer, what strategies would you advise that buyer to implement to get to know the seller's management and key employees so they feel comfortable with the deal? And to that end, with travel restrictions in place and social distancing requirements still around, what could a buyer do to get comfortable without having the option to do physical site inspections and the like?
Yeah, so that's definitely a real challenge in today's environment as a buyer in the M&A transaction. How do you get comfortable? So I think, typically you're going to have some type of a deal warehouse, where documents are posted. That will continue. I think if anything, we'll see enhancement in that area. Obviously more meetings like Zoom meetings and things like that with key leadership present. Typically those would have been on-site type meetings that you would have all hands on deck, or key leadership meeting with the prospective buyer. So more type Zoom meetings or go-to meetings, those types of things. I think, as Valentina mentioned, a lot more of this forensic due diligence will be critical. So would expect that buyers are going to be taking a real hard look at historical trends, historical sales information, and looking at the impacts of COVID on those historical numbers and discounting them significantly. So, but I do think a lot of it's going to be similar to what we're working with today in our environment, just working with clients and in business in general today is, a lot more remote, using teleconferencing, Zoom meetings, go-to meetings, things of that nature. Valentina, do you have any other insight on that you've seen as you've been working through?
So first of all, I would agree with everything that you said. And I think, what we're noticing is just that every week that passes, again, people are conforming to the new normal. So when we had deals, I think there was one specific deal that we were just about to receive our final round of offers just before COVID-19 hit. And we put the deal on hold because we didn't know how we were going to run management presentations if we got those offers and what was going to happen. After sitting, on that deal for about 45 to 60 days and understanding now how the industry has evolved, we went back out to market, talked to all of those buyers. We received bids, again, very attractive bids, and everyone is perfectly comfortable moving to online management presentations. So I think that's the biggest shift. We always viewed these presentations as a way for the buyer and seller on a personal level to see each other, get comfortable with one another, and then decide if they wanted to move forward. I think what we're really seeing that now is it's the exploratory stage, and you can certainly do that over Zoom. Is it as nice as sitting across from someone at a table? Well, not really. But the purpose of that meeting is to determine whether or not there are potential synergies between the buyer and seller. And you can conduct that diligence through a Zoom meeting. I also believe that the stage that we're at, those deals where we're conducting management meetings today, we're not going to be launching a final deal, like the final LOI or due diligence for probably another 45 to 60 days. So within that period, a lot of the economy is going to reopen, and I think that we will be in a position where you're going to start to see, a face-to-face meeting. I still believe, and I don't know if this will change, that at some point before a closing and both buyer and seller agree that this is the right thing to do, I think that face-to-face meeting is going to have to occur. But I think, as Lee pointed out, the virtual due diligence, the management presentations, the confirmatory due diligence, all of that can be done online. And then again, probably 30 days prior to close, there's going to be a need to see these people face to face.
Yeah, absolutely. And of course, there's always social media, which sometimes you can't help yourself to use social media as a data tool during these due diligence periods, which could give you to the type of person you're interacting with. The next question I have, maybe it's something Valentina could take and you could pile on. Can you describe any additional or enhanced reps and warranties you would expect buyers to demand from sellers resulting from COVID-19?
Yeah, so, again, I think this is going to be an evolving point, and I would not want to be an attorney, an M&A attorney during this time, because I think they're going to have their hands full. So I think probably the biggest changes we're going to see are to fundamental reps and warranties. So historically, fundamental reps and warranties have been around title and capacity, could be insolvency or environmental. But now I think what we're going to see is that those fundamental warranties are going to include issues like contingency planning and IT resilience. They're really going to cover the company's business from start to finish. And again, remember that a fundamental rep, different from your traditional reps and warranties, isn't a term that is typically 12 to 18 months. These fundamental reps usually either align with the state term, as in taxes, or they're usually a 3 to 5 year period. So that's where I think sellers are going to see some asks of the buyers that they're going to have to get comfortable with and decide how they deal with it. The other point would relate to disclosure. So I believe that buyers are going to heavily resist coronavirus disclosures. And what's going to happen is that those points are going to be required to be built into the price and negotiations. So obviously the attorneys are going to try to have these, coronavirus clauses, built in there, and I just don't think that the buyers are going to accept it. And probably the other thing that relates to the reps and warranties is the use of rep and warranty insurance. So I would say in the last 9 out of 11 deals I've closed, my sellers and buyers have advocated to use rep and warranty insurance. And for those of you that aren't familiar with that, it effectively is a policy that has, minimal premiums. That the post-acquisition period. Again, it made it very easy to do due diligence because you had this umbrella insurance that was effectively, there for you to access. Unfortunately now, I don't believe that those rep and warranty insurance they're going to have a COVID wrapper. And I just don't know how comfortable buyers and sellers will feel that whatever happens post-close pre-close isn't going to somehow be included in those exclusions. So unfortunately, we have to see how that plays out, but I would say that's probably, the other biggest change we might see. Also, most definitely, broadened definition of MAC clauses. I think you're going to start to see breakup fees, and then, completion of deliverables. The negotiations of the SBA are going to be elongated and much more involved.
Great. I just had one more question. I think maybe both of you can tackle this. So what advice would you give board members as they reassess the economics of a transaction post-COVID-19 so that they have the confidence that it'll create long-term value for stakeholders?
Lee, do you want to maybe take that one on and I can add to it?
Yeah, sure. I think, obviously talked about the buyers doing this forensic due diligence. I would definitely question as a board member to understand that due diligence that has been completed and question, how this business is going to look in a post-COVID environment as far as, all the key kind of business drivers. In particular, it's focused on its growth and its business development efforts and how that will look like in the future. So for example, are there certain sales that are likely to be difficult or challenging product services that they're offering in this new environment. Are there ways or methods of deploying those services? In particular, their supply channel, is there challenges that they may have? Do they need to broaden that supply channel in certain ways, and what type of investments would be required there? So I think that's where I would really, as a board member, on the side of a buyer that's looking to acquire a company or do an M&A deal, I'd really want to understand what type of due diligence was done to get comfortable that this business will be sustainable in the future, that it can continue to perform, and understand what type of level of investments might be required in order to get there. So there's some of the things that I would think as a board member I'd be really concerned with. And one thing in addition, to follow up on the reps and warranties, and I don't know if this exactly fits into the reps and warranties, but one thing that I've seen is a lot of businesses where they've collected some type of fees or revenues in advance of performing those services. And I've seen this because of COVID, they've had to kind of delay or cancel some of their services and activities. And I would be challenged a bit just to make sure that as part of the acquisition that there's not any hidden liabilities or hidden performance obligations where post-transaction that business now has to perform under those contracts or under that revenue that they collected already. But the seller actually already recognized that it was revenue, or already spent that money. So those are just some of the things that I would be thinking about.
Yeah, I would just add to that last point too, Lee. So the most important thing as a board member is make sure you understand what assets, the company is actually buying and can buy, and whether they're encumbered. I think, the changes that are happening during this period, it's critically important to assess that. Also, I think the biggest concern here as a board member is, are we paying too much, and how are we protecting our downside? So some of the structural things that I said are going to be impactful to a seller, we're on the buy side. That's something you can consider. And again, whether that's earnouts or seller notes, or things that limit the initial capital outlay at close. But also, if there is significant uncertainty as to how the company will perform, just consider, perhaps an alternative arrangement with the seller. So take an equity stake or set up a joint venture. Again, the earnout is a great way to hold a business to, accountable for what they think they can do in the future. Again, it's not attractive from a sell side standpoint, but it's certainly attractive from the buy side. I will say that I'm on a board of a business. We actually transacted a deal. It just closed last week, but we were in the midst of our negotiations right in the middle of March. And, as board members, what we were looking at was, strategically, does this deal make so much sense that regardless of what happens to the business, if they lose 30% of their revenues, or, the industry, takes a bit of a nosedive, what will happen, and what we're paying worth what we're getting? And when we looked at the deal, we financed it through an asset-based loan. So all of the assets we could have liquidated and paid for the company. We were primarily purchasing employees as well as equipment. So the way we looked at the cost of that purchase, if we went out and tried to do it, first of all, it's very difficult to find qualified employees. But then even the equipment, trying to purchase that would have outweighed the cost of the purchase. So that's kind of the analysis we did. And then also, given that, the company was probably, I would say, dire straits to sell, we believe we got a very advantageous price. So those are some of the things we looked at as board members and concluded, despite what's happening in the overall market, we have an opportunity here to do an acquisition, and we firmly believe that down the road, that acquisition is going to return a very high yield.
Thank you, Valentina and Lee, for your time and talents. That concludes our Q&A session. So on behalf of myself and my colleagues, we want to thank the audience for joining us. We hope you found the information useful. If Mercadien or BDO could be helpful to you in any way as it relates to evaluating your M&A options, or just tackling other business challenges during these difficult times, don't hesitate to reach out. Our contact information is on your screen, and the entire slide deck for today's webinar will be made available to all participants. So thanks again for joining us, and please stay tuned for future knowledge and insights from our team. Have a great day. Take care.